MCI is paying a yield of 8%, and it's been around for more than 50 years. AIPI is yielding 34%, and it's less than a year old. What do these funds have in common? They're both on my radar for future investment. Most income investors keep a watch list of what they're considering to buy next. If you'd like to see mine, stick around. I haven't done deep dives on these 5 funds yet. Today, I'm just going to tell you how much income they make, what they are, and why I'm interested in them. Let's jump straight in. AI is short for Armchair Income, but this fund is focused on the other AI, artificial intelligence. Anytime a fund is less than a year old, you'll see wildly different yields on different websites. That's because some formulas don't work with less than 12 months of data. So anytime a fund is less than 12 months old, I check the math myself. I took the average of the 5 distributions paid so far, that's $1.48, then multiplied it by 12 and divided by today's price of $51.80 to reach an annualized yield of 34%. That's a huge number. I'll explain why shortly. So far, the distributions for AIPI have been quite consistent, but it's early days. So how does AIPI generate a 34% yield from AI stocks? The short answer is options. It sells call options on AI stocks. The AI stocks are based on an AI index called the BITA AI Leaders Index, which is a mouthful. Here are the current top 10 holdings for AIPI. Palantir, CrowdStrike, and NVIDIA make up over a third of the portfolio, so it's pretty aggressive. AIPI holds the AI stocks in its portfolio and generates income by selling call options on those stocks. It's effectively selling some of the upside. For example, if they sell options 5% out of the money, that means any appreciation above 5% goes to the buyer of the option. This places a limit on how much AIPI can appreciate. So why am I interested in this particular fund? Because usually when you see a 34% yield, there's a lot of NAV erosion, meaning the price trends down. It's early days, but AIPI's current price is almost the same as when it launched. Even though you could make more money by holding Palantir and NVIDIA stock yourself, from an income investor's perspective, the fund is interesting because option prices are driven by volatility, and these stocks are extremely volatile. So AIPI receives a lot of income for selling calls on them, hence the massive yield. This fund should do well in a bull market or a sideways market. During a tech crash, though, it will get hit hard. I wouldn't be surprised to see its value cut by half. These stocks have the ability to recover quickly from a crash, but the fund won't recover as quickly as the underlying stocks because it's selling some of the upside with those call options. In summary, since its launch in June 2024, AIPI's price dipped with the Nasdaq 100 in July, and then it didn't recover as quickly as the Nasdaq 100. That's the nature of covered call funds. But the good news is when we include the dividends by looking at a total return chart, the gap shrinks considerably. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth. And this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, although today we'll look at some that go quite a bit higher than that. If you'd like a copy of my portfolio, it's available via Armchair Insider. Link in the description, it's free. XDTE is currently yielding 21%, but that's a moving target. What's unusual about this fund is that it pays out weekly instead of monthly or quarterly. The distributions are, well, all over the place, ranging from 2 cents to 41 cents. This is another new fund, so I estimated the yield by taking the last 10 weekly distributions, calculating the average, which is 21.34 cents, then multiplying by 52 weeks and dividing by today's price of $53.10. The result is an annualized yield of 21%. By the way, these distribution charts aren't available on my Schwab brokerage account or on Yahoo Finance. I use either Seeking Alpha or Snowball, depending on which program I'm in at the time. I also use Snowball to keep track of my income. I can rank my portfolio by current yield to see if there's something I want to sell. I can check the yield on cost, and most importantly, I can see a calendar that tells me how many dollars will arrive on any given day of the month. Link in the description for a discount and a free trial. XDTE is another covered call strategy, but this one is based on the S&P 500. There are three things that make it unusual. Number one, the weekly distributions I mentioned earlier. Number two, instead of holding the S&P stocks in the fund, it uses options to replicate the price movement of the S&P 500 index. This is known as a synthetic covered call strategy. The third differentiator is that it uses daily options. Most covered call index funds sell options about a month out. XDTE uses these ultra short duration options called 0DTE. It looks like ODTE, but the acronym actually stands for 0 days to expiration. I can show you why I'm interested in this fund with two charts. First up, despite paying out huge distributions, the price has held up. Each time the price dipped, in the past at least, it recovered fully. And then the second chart includes distributions, because this one's a total return chart. Usually a covered call index fund will underperform its index, but so far this one is actually slightly ahead of the S&P 500. Of course, we don't know how it will react in a bear market because it's so young, but there's enough to like so far to at least keep my interest. MSD is currently yielding 12.1% based on the last 12 months of distributions. If you only consider funds with a long history, this one goes back 30 years. There are so many little lines on the full distribution history chart that it's a bit hard to see any real trends. But if we narrow it down to the last 10 years, we can see that the income has been trending up in recent years. MSD is an emerging market debt fund managed by Morgan Stanley. Most investors are focused on the US, but if you don't want to have all your eggs in the US basket, this fund offers some diversification. Here are the countries that the fund is most heavily invested in. The investments are in the form of bonds. Roughly 2/3 are government bonds and 1/3 corporate bonds. The credit risk is higher than for a similar US-based fund, but so is the yield. I'm interested in this fund for two reasons: diversification and an unusually long history. The fact that it's managed by Morgan Stanley is also a plus, because they have substantial global resources. PAXS is currently yielding just over 11%. It was born at the beginning of the 2022 bear market. Not the best timing. The good news is that the distributions have been quite consistent. There's been one dividend increase and one special payout. So far, so good. PAXS comes from PIMCO, one of the largest fixed income fund managers in the world, with over 2 trillion, that's trillion with a T, under management. I already hold 2 PIMCO funds in my portfolio, PDI and PFN. Maybe this one will become a third. PAXS is weighted towards fixed income, which includes a wide selection of bonds from governments and companies inside and outside the US. PAXS is a catch-all for high-yield fixed income, which means it will do well if interest rates continue to fall. I don't know which way interest rates will go over the medium or the long term, so I'm looking to hold a mix of fixed and floating rate funds. A couple of things to be aware of. Number one, it's 42% leverage, that's high, which helps explain the high yield. Some investors don't like the risk and the expenses associated with that amount of leverage. Number two, it's a closed-end fund and it's trading at a 4.65% premium to NAV. On a price to NAV basis, it's a little bit expensive now, but then again, what isn't? If you'd like to learn more about PAXS, Stephen Fiorillo is one of my favorite analysts, and his article on Seeking Alpha explains the risks of investing in PAXS in more detail, and also how that fund is affected by interest rates. Seeking Alpha is my primary source for all things income investing related. Link in the description for Stephen's article, and there's also a link for a discount on Seeking Alpha membership. I use the premium level of membership. MCI is currently yielding 8%, and this is the oldest fund I've ever seen anywhere. It was born in 1971. Most websites don't have data going back that far. Snowball's chart goes back to July 1980. That's when people started listening to music on compact discs. There have been some ups and downs, but generally, any distribution cuts have been followed by distribution increases. MCI is a credit fund that's mostly made up of floating rate private loans to corporations. These are below investment grade loans, so there's default risk. However, given the fund's long history of navigating almost every market shock imaginable, I think they've shown an ability to manage risk. Over its long history, the price of MCI has had some dramatic ups and downs, but I like the fact that it has always managed to recover from corrections and continue to pay those high yields. As I mentioned earlier, I'm looking to hold a blend of fixed and floating rate funds, and this one fits into the floating rate bucket. Here are two total return charts for MCI that I think are interesting. First up is the bear market of 2022. You may remember this as the year when you stopped looking at your brokerage statements. If you think below investment grade is too risky, look at how MCI held up versus the S&P 500. Looks like MCI knew what it was doing. The second chart is zooming out to 30 years of total return. The S&P 500 over that period has returned more than 2,000%, which is not bad. If you held MCI over that period, you received an extra 1,000%. For these reasons, MCI is often expensive compared to its NAV. It's currently trading at a premium of just over 20% to its NAV, which is expensive. However, in the past year, that premium dropped to almost zero twice. So with a little patience, perhaps that opportunity will repeat itself. That's what's on my radar, so what's on yours? If you have some insight on these 5 income investments or others that you think are even better, drop a comment below to continue the conversation. And if you're curious about my current income investments, click here for a recent update of my top 10 holdings. That wraps it up for this look at income investments on my radar. More Armchair Income coming soon. Armchair Income.